The single biggest mistake farmers make when comparing loans is focusing only on the interest rate. Most people think comparing loans is about finding the lowest number. The truth is, it's about finding the right structure. After helping hundreds of farmers secure over $1 billion in finance, I can tell you the best deal is rarely the one with the lowest advertised rate. So in this video, I'm going to give you the exact 7-step framework I use to find the loan that's actually the cheapest and the best for your farm. Starting with the first thing you need to look at, and that's the upfront costs. These are the costs that you pay before the loan even starts, and they can vary widely between banks. We're talking about the application fees, the legals, the documentation fees, and the settlement fees. These can range from a few $100s to several thousand, and two loans with the exact same interest rate can have a $5,000 to $10,000 difference in setup costs alone. Some lenders will advertise a super low rate, but they make their money back by charging a massive application fee. And this is a classic trick. So the first step is to ask the bank for a full breakdown of all the establishment costs. Let's get it in writing, ask them if any of these costs are capitalised into the loan, meaning you're paying interest on them, and whether they're refundable if the deal doesn't go through. And don't get caught out before you've even started. The next thing we need to consider is the valuation. A rural valuation is not like a residential one, where someone just drives past the house. It's a full-blown financial assessment of your property. It's your business. They're looking at the land, your water rights, infrastructure, your production history, everything. And because they're so complex, they're expensive. A typical rural valuation can cost anywhere between $2,000 or $10,000. And this is a huge variable between lenders. Some banks will subsidise the cost of the valuation. Some might even complete it internally. Some will require multiple valuations from different firms. Some will even require you to get it updated every few years at your own expense. And this can add thousands to the real cost of the loan. So you must ask your bank about their valuation policy and who pays for it, how often it's required, and how you can use a valuation you've already paid for. The answer to this can save you a lot of money. All right, now let's get into one that everyone focuses on, and that's the interest rate. And yes, it matters, but you have to look beyond the headline number. You need to ask if the rate is a variable or fixed. Is it an introductory or honeymoon rate that will jump up after 12 months? How often does the bank review the rate? And does the rate include a margin based on the loan to value ratio? For example, a bank might offer you a lower rate with much tighter terms and conditions, and another bank might be 0.2% more expensive, but they offer you the flexibility to make extra payments, redraw funds when you need them. Sometimes paying a little bit more for the flexibility can save your business in a tough season. Be sure not to just ask for the rate, but for the full context around it. Understand the trade-offs between a low rate and flexibility that you might need down the track. The next one's a silent killer, and that's the line fee. Many rural loans are set up as lines of credit or overdrafts, and the bank charges you a fee for the total approved limit, whether you use it or not. You're paying for access to the capital, not just the money you've got drawn down. A typical line fee is anywhere between 0.1% to 0.5% per year. So let's run the numbers on this. If you had a $2 million facility with a 0.25% line fee, that's an extra $5,000 a year you're paying, regardless of whether you use the dollar of that loan or not. It's pure profit for the bank. So make sure you're always asking, is there a line fee? And do the maths. A loan with no line fee, but a slightly higher interest rate, can often work out to be a much cheaper option for you. And that brings us to the line fee's evil twin, the unused limit fee. This is another fee that's often overlooked, and it's charged on the portion of the loan limit that you're not using. It's common with working capital facilities or seasonal lending, where you might not need the full limit for the entire year. For example, let's say you have a $1 million working capital facility, but you only use $400,000 of it for most of the year. That leaves $600,000 sitting there unused. And if the bank's charging you 0.5% unused limit fee, that's an extra $3,000 a year in fees. It's a penalty for being prudent. When evaluating options, look at your cash flow and be realistic about how much you'll actually use. If you don't need a full limit, don't pay for it. Ask the bank if they can charge an unused limit fee. And if they do, consider reducing the limit. An unused limit fee can add up over time and add a lot of cost to your facility. Now, the next point is sometimes more important than the cost. The flexibility of the loan. Farming income isn't like your monthly salary. It's lumpy, it's seasonal. You might only get paid once or twice a year when you sell your cattle or your crop. So a loan with a rigid monthly repayment can put a huge strain on your cash flow. A good farm loan should be structured around the rhythm of your farm. You need to look at the features like the ability to redraw funds if you need them, seasonal repayment options that match your income cycles, and the ability to make interest-only payments during tough periods, and the freedom to pay your loan off early without massive penalties. A loan that looks cheaper on paper but locks you into a rigid structure can be a nightmare. There is a lot of nuances to this step, and it's one you don't want to get wrong. If you'd like some help securing the best loan based on your circumstances, you can book a free consultation via the link in the description below. And that brings us to the final and most important step. It's putting it all together to calculate your total cost of credit. This is where we add up everything we've talked about: your upfront costs, the valuation costs, your interest repayments over the life of the loan, line fees and other fees. This is the only number that matters, and this is how you compare apples with apples. As a broker, this is what we do for my clients. I take the offers from different banks, I model them out over the full term of the loan to see what the true cost is. And 9 times out of 10, the loan with the lowest headline interest rate is not the cheapest option. Create a simple spreadsheet, plug in all the numbers, and calculate the total cost over 5 or 10 years. And that's how you make a smart, informed decision. So there you have it, the 7-step framework for actually comparing your farm loan options. It's not just about the interest rate, it's about the upfront costs, valuation fees, line fees, the flexibility, and your total cost of credit. If you go through these 7 steps, you'll be in a position of power. You'll be able to see that through the bank's marketing and make a decision that's right for your business. And if you want a hand with this, if you want someone to do the heavy lifting for you and create a competitive environment where the banks have to fight for your business, that's what Seasoned Finance is best at. We know the questions to ask, we know where the hidden fees are, and we know how to get you the best deal. So if you'd like our help, book a free consultation using the link in the show notes. And remember guys, don't get caught in the interest rate trap. Look at the whole picture. Thanks for tuning in to Dollars in the Dirt. If you've got value from today's episode, make sure to subscribe so you never miss the insights you need to grow your business. And if you're ready to stop being just another number to the banks, visit Seasoned Finance via the link in the show notes. Remember to follow us on socials, and catch you next time.